Hey everyone, welcome back to Corporate Decoder. Today, FingerMotion Incorporated just filed their quarterly 10Q report for the period ending May 31, 2026, and the numbers reveal a pretty stark picture of their recent performance. Quick note, this is not financial advice, just my take on public filings for educational purposes. Revenue has absolutely cratered, but interestingly, their gross profit actually went up. Let's dig into what that means. So remember, a prospectus supplement is basically an update to a company's offering documents. This one is updating the prospectus that was dated the 22nd of June 2026. It is telling investors that an updated quarterly report is now available, and they should consider this new information. This is the main event for today, the Form 10Q, a quarterly report that gives us a snapshot of the company's financial health. FingerMotion Incorporated filed this for the quarter ending May 31, 2026. This tells us the report covers the 3 months leading up to May 31st of 2026. And as we'll see, it was a pretty rough quarter. Now we're getting into the meat of the financials. This is the balance sheet showing what the company owns and what it owes at a specific point in time. Look at accounts receivable. It has stayed pretty steady around $44.8 to $44.9 million. This is the money customers owe them. While it hasn't jumped dramatically, the overall revenue picture makes us wonder how quickly they can collect this. Then you see prepayment and deposit at over $4.9 million. That is a significant chunk. This often means they've paid for services or goods in advance. For a company struggling with revenue, a large deposit might make you scratch your head wondering if it is the best use of cash. Total assets are about $61.9 million. This is the total value of everything the company owns. On the other side, you have accounts payable. That is around $35.1 million. This is money the company owes to its vendors and suppliers. Notice it is quite high compared to their cash. And total liabilities are substantial at nearly $48.6 million. This is all the money the company owes to others. But here is the kicker: total stockholders. Equity is only around $13.3 million. This is what is left after you subtract liabilities from assets. A low number here, especially when combined with the accumulated deficit we'll see later, is a red flag. This is the income statement, the real story of how the company performed financially. And here is the headline revenue for the 3 months ended May 31, 2026, was just $650,089. That is a massive drop from $8.4 million in the same period last year, a 92% nosedive. That is like losing almost every single one of your customers. Now, look at cost of revenue. It dropped from over $8.3 million to just $441,611. This makes sense because if you are selling way less, your direct costs go down. But here is that little glimmer of hope: gross profit, which is revenue minus the direct cost of selling goods or services, actually increased from $152,521 to $208,478. That is a 37% jump. This means that the profit they're making on the sales they are making has improved. This is often because they've cut down on the lower margin business and are focusing on what is left. Operating expenses are pretty much flat, around $2.14 million for both periods. This is notable because revenue fell off a cliff, but they didn't slash their operating costs proportionally. This leads to a net loss from operations of about $1.9 million. And overall, the net loss attributable to the company's stockholders was just over $2 million for the quarter. That is a lot of red ink. And when you look at the accumulated deficit, it is a staggering $43.1 million. This is the total net loss the company has incurred since its inception. It just shows they've been losing money for a long time. This is the cash flow statement. It shows where the company's cash came from and where it went. Here is the tough part. Net cash used in operating activities was a negative $2.3 million. This means their core business operations are burning through cash. But they did get a significant boost from financing activities, bringing in $3.27 million. This is largely because they issued a convertible note. So despite the cash burn from operations, their cash balance at the end of the period actually increased to just under $1 million, up from only $68,000 at the start of the quarter. This inflow from financing definitely helped them stay afloat. This section gives us some background. FingerMotion Incorporated, originally Property Management Corporation of America, changed its name after a change in control. They acquired a Hong Kong company that was in the mobile games business. The whole setup is a bit complex, involving accounting for it as a reverse acquisition. This is a critical part of their business model, especially when operating in China. A variable interest entity, or VI, is used when foreign companies are restricted from directly owning certain types of businesses in China. FingerMotion uses contractual agreements to control their VI and consolidate its financial results. It is a common structure that carries its own set of risks. Since they operate internationally, currency fluctuations matter. This shows the exchange rates used for their financial statements in US dollars. For instance, the rate was about 6.77 renminbi to $1 at May 31, 2026. Let's look at accounts receivable again, which is at about $44.9 million. They've also increased their allowance for credit losses to over $2.2 million. This suggests they're becoming more cautious about their ability to collect money from their customers. This note details various issuances of common stock. It is a lot of activity, including shares issued for services, warrant exercises, and private placements. This constant issuance of shares can lead to dilution for existing shareholders. This section outlines the company's outstanding stock purchase warrants. These are essentially options to buy stock at a certain price. You can see the number of warrants and their exercise prices. They also had an adjustment that changed the exercise price of some warrants to $0.94, largely due to a convertible note they issued. Similar to warrants, stock options are another way companies compensate employees and consultants. They grant the right to buy stock at a set price. The details here show how many options are outstanding, their exercise prices, and their fair value at the time they were granted. This section breaks down their earnings per S-share or EPs. Since they have a net loss, it's presented as loss per S-share. For the quarter, it is a loss of 3 cents per S-share, both basic and diluted. This means for every share of stockholders are associated with a loss of 3 cents for the quarter. Here they discuss their income tax situation. Given their losses, they have a deferred tax asset, meaning they might be able to use these current losses to reduce future taxes. However, they also have a significant valuation allowance, which is essentially a reserve against these deferred tax assets, indicating they're not sure they'll be able to use them all. This is about a loan payable, mostly from a Dr. Liu Yaoming. It shows a significant amount in SGD Singapore dollars and details the interest rates, which are quite high, up to 12% per annum or even 24.5% per annum on some extensions. High interest rates on loans are a major red flag, especially when combined with revenue struggles. This is a significant development. On May 13, 2026, they issued a senior secured convertible note for $5 million, but with a $700,000 original issue discount. This means they effectively received only $4.3 million up front. The note is convertible into stock. Convertible notes can be tricky because if the stock price goes up, the company has to issue more shares to cover the conversion, diluting existing shareholders. This is where the company highlights the potential dangers. It is always a good read to understand what keeps management up at night. This is a blunt statement of their ongoing problem. They've consistently lost money and there is no guarantee they'll become profitable. This is a critical risk for any investor. They heavily rely on just two customers, China Unicom and China Mobile. If those relationships sour or those companies have issues, FingerMotion is in big trouble. This is a classic concentration risk. This section dives deep into the risks of their VI structure in China. It highlights that Chinese regulators could deem these agreements invalid, which would severely impact their operations. It also mentions potential conflicts of interest with the VI's shareholders. This is a huge area of uncertainty for companies operating in China through VI's. This is a warning to investors about trying to sue the company. Since most of their assets and management are in China, it could be very difficult to get any kind of legal recourse if things go wrong. This is about their internal financial controls. They are stating that management looked at how well their financial reporting systems are working, and the conclusion, they're admitting their internal controls are not good enough. This is often linked to a lack of staff and oversight. For a public company, this is a serious weakness. It means to raise a higher chance of errors in their financial reporting, and it raises questions about the reliability of the numbers we're seeing. They say they have a plan to fix these control issues, including better segregation of duties. However, they also point out that testing these new controls hasn't even started. This suggests it is going to take time, and there is no guarantee they'll be effective. This is just a list of attached documents like certifications from their CEO and CFO and XBRL files. It is standard procedure. Now, looking at these results more broadly, FingerMotion Incorporated is in a tough spot. Their core revenue stream has all but vanished. A 92% drop is catastrophic. While they manage to improve their gross profit margin on the sales they are making, that is cold comfort when the overall revenue is so low. They're burning through cash in their operations, and the increase in cash on hand is thanks to new debt financing, not from successful business operations. The high interest on their loans and the convertible note add further pressure. Furthermore, the admission of material weaknesses in internal controls is a significant concern, suggesting a lack of robust financial oversight. The risks associated with their VI structure and operating in China are also substantial. My biggest concern is their ability to generate meaningful revenue to become profitable, especially given the massive drop and the reliance on just a couple of telecom companies. What I am actually looking for is a clear path to sustainable revenue growth and profitability, which is not evident in this report. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis valuable, please like and subscribe, and join our Discord community linked below.